Crypto Hotep here with another investing video. We are on week 116 of the Family Portfolio and Dividends Tracker. Thank you guys again for tuning in. I really appreciate the support as always. And thank you for everyone who has been listening since week number 1. Before we jump in here, if this is your first time watching the video, basically I gave my family a list of individual stocks to choose from in the beginning. And then most recently, we actually switched to ETFs for less complex investing and easier process for investing. So now we don't have to worry about individual stocks of individual companies and if they have a bad year or not. We can just invest into ETFs and let kind of the process take care of itself. If you're unfamiliar with ETFs, I can make a video on that as well. To describe the benefits, the pros, cons, that type of thing. But basically, in a nutshell, the choice to go with ETFs was just the ease of investing and more of cruise control. So before we get into it, guys, this isn't financial advice. None of this is. If I sound a little nasally, allergies are kind of kicking my butt right now. So, but none of this is financial advice. If you don't have an M1 Finance account, we use M1 Finance. The link is in the description below. And just because my family invests in certain ETFs, that doesn't mean you need to as well. But as always, guys, please like, subscribe, comment, share the video. And please hit that notification bell so you know when these videos come out every week. So before we go to week 116, we go to 115. Last week to see where we were at. We were at 43.50 and 16 cents. That was a money weighted rate of return of 0.77%. Market gain of looks like $1 and negative $1.12. Dividends earned of $32.52. So what happened this week, 116? So week 116 showed us with a balance of $4,271.44. So we went down. The portfolio market weighted rate of return is a negative 1.54% year to date. That includes a market gain of a negative $95.17, and then dividends earned remain the same at $32.52. And primarily this is because of the geopolitical events that are going on. Seems like week in and week out with Middle East. So those have been playing a huge factor on the markets, and the markets are dipping currently. And even in ETFs aren't foolproof either. But again, with investing, you have to take the ebbs and flows, and you have to understand that the market isn't always going to go up, and there's going to be dips, there's going to be corrections in price, and you need to be more. When there are corrections in price, you need to be sure that you have money on the side ready to put into these markets when there is a dip or a correction in price, because now you're able to buy these securities or assets or whatever you choose to invest in at a lower price. The good thing is with ETFs, you can buy the ETFs at a lower price, and it feels a little bit safer than the company, because some companies can go to zero or they can keep dipping. Most of the time with ETFs, if you select the right ETFs, they will turn around eventually, right? So with that being said, let's go to the activity between this week and last week. So last week saw us with a deposit. I believe last week was a deposit. It's also a deposit of $15. We did do a couple buys with our deposit. So we had 5 buys totaling out $15.33. So we bought some SOXX, VCR, FSTA, XLY, and then QQQM. So we bought all these, and this is a prime example if you don't need a lot of money to build generational wealth. Now, is it going to take a longer time? Of course it is. You're not going to be building generational wealth overnight with $15 deposits. That's just how it is. But if you're consistently investing with that money, you will see the fruits of your labor within a year, within 2 years, 3 years, and so forth and so on. But you have to be consistent with it. And that means being consistent when the markets dip. Case in point. So let's Go bottom to top here as we always do. The bottom, unfortunately, my wife. My wife has a balance of $620.13. Money weighted rate of return of 7.65%. Negative 7.65%. Market gain of a negative $51.86. Dividends earned of $4.89. So with my wife's, we have QQQ, FSTA for consumer staples, somewhat defensive, and then XLY for consumer discretionary, right? So these three ETFs make up my wife's portfolio, and unfortunately, the only thing that's really in the green, or that is in the green, is the consumer staples. It's that defensive position that we have because everything that is very volatile is in the red right now. So QQQ, which is mostly technological companies, and then consumer discretionary are basically the companies that provide services that aren't a need, right? So those right now, especially with the economy in flux, geopolitical with Middle Eastern, people not really sure what's going on, you're going to see a dip in those. You're going to see a spike in the consumer staples because those are the quote unquote safer options right here. And we'll see that in the upcoming portfolios here. So let's go to our youngest. Our youngest is or has a balance of $648.81. Money weighted rate of return of 0.83%. Market gain of 81 cents positive, and dividends earned of $4.10. So very similar to my wife's, we have QQQ, FSTA for those consumer staples, consumer discretionary, very similar rates of return here, negative, positive, negative, but ESPO, the video gaming ETF, is negative, so negative 0.83. Now, with these, you have to remember that, again, ETFs, you're not going to see the big swings in the dips. There are certain ETFs that you will see those big swings in the dip, and they do have volatile ETFs that react almost like individual stocks. But the longer standing ETFs, like from a Vanguard or from Fidelity and such, those will give you like modest to expectable returns, right? So usually around that 10 to 15%, and then could dip 5-10% as well. So you have to keep that in mind. Our middle has a balance of $659.26. Money weighted rate of return of a positive 7.86%, so still doing well there. Market gain of $38.77, and then dividends earned of $5.30. Okay, invested in the QQQM, but we know the deal there. Consumer staples, we know the deal there. And then we have Vanguard consumer discretionary here with VCR. And the only reason that we did that was because there were certain items like Target, for instance, that our middle had in individual stocks that tied closer to VCR or the Vanguard consumer discretionary ETF than, say, XLY, which was the State Street consumer discretionary ETF. Okay, ESPO, though, is still in the negative 0.82%. So as you're going through this and you're seeing, man, crypto hotep, there's a lot of red in here, and it's like, yes, it's a lot of red, but for me, now that we're strictly ETFs, it makes it even more attainable to say, hey, it makes it even, I guess, better to say, hey, we're buying in at these dips versus saying, hey, should I put my money into this one company and cross my fingers here? So now we have the ETFs. The ETFs are doing the hard work for us in terms of picking the winners and losers. We just want to make sure we're buying at lower prices whenever we can. And then my stock portfolio, we have a balance of $1,148.10. Money weighted rate of return of a negative 6.29%. We're dipping low here. Market gain of a negative $83.47. Dividends earned of $10.04. So the reason is I redid my portfolio because my other investments in M1 Finance are broad market ETFs, dividend income ETFs, VU, VGT, for instance, and those type of things. This portfolio we want to play around, have a little fun money with this one. So I just did research on ETFs where I think we'll be here 10, 15 years down the road and play off of that industry. So for me, that was chips, semiconductors, quantum computing, and cybersecurity. Those are the biggest things I feel as though are going to be some of the biggest narratives to invest in, not financial advice, in the upcoming years. But again, those are the most volatile. Um, these are the most volatile industries currently, especially semiconductors. So we have SOXX and we have SMH. Those we are down over 6%. That's huge. But at 1 minute, at the flip of a switch, these two ETFs can jump 10, 15%. So they move very quickly, but they can drop. So this is what I'm talking about, where you can have those volatile ETFs where you can get those gains, but you have to be very patient and diligent with waiting out the bad times. Cloud computing, we're down over 5.5%. Cybersecurity, though, is up over 2%. Makes me feel good, though, because again, when you're talking about semiconductors, quantum computing, and cloud computing, you need to keep that safe and secure. Cybersecurity is huge with that. So CIBR up over almost 2.25%, and then quantum computing, Defiance Quantum ETF down over 11%. Am I worried about that? I'm really not, because I'm thinking long term with that. And last but not least, go to our oldest. Our oldest has a balance of $1,195.14. Money weighted rate of return year to date of a positive 0.77%. Market gain of 58 cents, I should say, and then dividends earned of $8.19. Very similar to my wife's QQQM, FSTA, and then XLY. Red, green, red. All good though. And again, this is because of external factors that you see, but I think the biggest thing you need to think about is when you're investing, you need to think about investing in the long term. Trading and investing are two separate things, and you have to realize that. Trading is more short term, investing is more long term. If you're investing, you're putting that money in and you're not worrying about that money for 5, 10, 15 years down the road. If you're looking at making a quick flip and you need that money in the next year, I wouldn't invest it, right? I'd probably just honestly save it in a high yield savings account, especially if you're going to need that money in a year, meaning that you're going to need it for actual need or a want. Because if you trade it, you could lose that, and you could lose a lot of it. So you have to keep that in your mind, because you're going to have to switch your mindsets when you're investing. Investing's more for the long term. That's why these up and down swings each week that we've seen, they really don't mean anything. You need to look across the longer term, where we look at year-to-date numbers. We also look at 1-year numbers as well, just to see how far we've come. And you can see here, like in August 2025, we were at $2,676. Fast forward, we're at $4,271. Yes, this is only up over 8%, but again, this is 1 year, and this is taking into consideration the major dips that we've had. So again, guys, for the week of 1/16, family portfolios $4,271.44. Money weighted rate of return negative 1.54. Market gain of a negative $95.17, and then dividends earned $32.52. This video is helpful at all, guys. Feel free to like, subscribe, comment, let me know what you think. And as always, guys, thank you and happy investing.